Good morning and welcome to our May monthly money meeting where we'll be talking about using credit wisely. As I indicated, feel free to raise your hand, unmute, introduce yourself, where you're joining us from. And if you're unable to unmute, you're most welcome to just type on the chat, send your greetings and tell us where you're joining us from. I simply just want to appreciate you taking the time on a Monday, which is a holiday and a workers' day where we're supposed to be resting, but commuting to being part of the session. So feel most welcome. And if anyone is keen, you're most welcome to introduce yourself. And also those that attended the budgeting one, the monthly money meeting that we had last month, you can just briefly tell us how is it going with your budget, how you're finding the template. Thank you. Yes, Mama Khadi.
Good morning, ladies and gentlemen. My name is Mama Khadi. I'm joining from Pretoria. I attended the budgeting last month and wow, I saw a lot of things that I was doing wrong, though I was budgeting, but there was a lot of mistakes that I was doing. And now with the template, I'm able to structure my budgeting according to my spending habits and know what needs to be done, where the money needs to go, where it needs to go to savings, investments, and all that, because sometimes we think we are saving or investing, and you are saving, not investing. So thank you very much for the last month's session. I really enjoyed it. Hope that joined today will also learn and get a lot of info and also give info as much as we can. Thank you.
Thank you so much for sharing. Over to you, Naki.
Good morning, everyone. My name is Nakesani Matiwa. I'm joining from Eastern Cape, East London. No, I did attend the first meeting. The template is very, it's good, but it's brutal. It takes you down the the line because there are certain things you don't realize that you are doing them wrong. But now when you put everything in one, it calculates, it shows you that actually you were not doing anything, because when you look at the money left and the money that you put in to insert there, be it you took from the statement, you find that you are left with nothing. And now it helped me a lot, yeah, to be honest with you. It's brutal. It will punish you, and in a good way. Yeah, thanks.
Thank you so much for sharing. Anyone else that would like to share? We'll take the last person and then we will start. I see on the chats we've got greetings from Tabisile, who's joining us from Kokstad. Thank you for joining us. We also have Paugelo, who's joining from Gato in the Northern Cape. And then she says it's the first time attending the session, hoping to learn a lot. We've got Maria Mvamadi, who is joining from Polokwane, who is currently in hospital, and then she missed the last monthly money meeting. Wishing you a speedy recovery, Ma'am Mvamadi, and we're glad that you're able to join us this morning. So for today's session, I just wanted us to have a conversation and not make it complicated, and we won't have brutal spreadsheets this time around because the spreadsheet is there. I think when I sent you the spreadsheet, the second section of the spreadsheet deals with debt. So what we're doing today, it's what in most financial literacy sessions we call debt management, dealing with debt. However, we know that there is debt and then there also is credit. So in our language, we say we are using credit wisely. And firstly, we define debt as when you borrow money and then now you have to pay it back with interest. So it's very important that you understand the cost of credit. I'm just going to share my slide, which is a document that is on PDF from our booklet. So today it's all about using credit wisely. And as a disclaimer, this is for financial literacy education purposes. So anything that will be shared on today's session is not considered advice. And if you need advice, feel free to reach out. I was chatting to someone yesterday and they were like, I thought in our meetings, you're going to tell us products that we can invest in. And then I said, no, I cannot recommend products on this platform. However, if you would like to have a session where we look at your current situations, your goals and needs, we are available. You can always reach out and then we have a session and then we help you put together your flexible financial plan. So when we talk about using credit, most people, surprisingly, when you even ask what debt is, they give you stories, they tell you about expenses, but debt is simply when you borrow money or use products and services, and then you have to pay it back with interest. And it's very important that you understand the cost of credit, because this interest is the money that you pay for using the debts, and it is also the money that you, just check, okay. It's the money, I just saw a chat, let me attend to that. They're not connected to audio. Okay, that should sort it. So you need to understand how much this credit is costing me. And in order to understand that, you need to understand that buying whatever you're buying on credit, it's going to result in an extra payment. And then that's what we call the cost of credit. So the item that you're buying, comparing to the cash price that you would pay, now you look at what is the monthly installment that I have to pay, and then the term in months, you multiply those two, you'll get the total repayment. And then the cost of credit will be what you pay less the cash price. So you can also calculate as a percentage where you look at the total repayment over the cash price multiplied by 100. This will show you how much you're paying in addition to the credit itself. So as we do these sessions, we ask a very simple question of, do you have debt? And this is a critical question. And the reason why we've included it here is that one needs to understand their starting point, and then also just admitting that the transactions that I've done in the past constitute debt, because there's people that are in debt, but they don't call it debt. They don't think that they're in debt. They don't process it as debt. So they don't see the need of putting together a plan of getting out of debt. And if yes, do you want to get out of debt? The reason why we asked this question is I once did a training and then asked if people wanted to get out of debt, and someone was saying, no, they don't want to get out of debt. And when I inquired further in terms of why they didn't want to get out of debt, they say that it's because the kind of debt that they are talking about or they have available is the store card, where they go and buy clothes, and because they have won the clothes, the company is not going to come and take away those clothes. And I was like, okay. And they were like, they'll never buy a car in credit because the car can be repossessed, the house can be repossessed. But now debt is debt. And managing or eliminating debt is a critical aspect of your financial plan, because if not managed well, it can prohibit you from reaching your financial goals. And another thing is to find out what is your debt story, like how did you end up there? Because there's different reasons. Other people lose their jobs unexpectedly. Other people are just choosing to not manage their finances well. Other people, they suffer from money disorders. Other people, it's materialism, it's addictions that they're dealing with. So it's important that you identify what your debt story is. So if you are in debt and attending this session, please make time to write your debt story. You don't have to share it with us here. You don't have to put it on the chat, but find your notebook where you're going to tell that story, to share, how did I end up here? Because people end up in different places for different reasons. You can even specify the things that you spent the money on. And as you go through that journey, it will help you to even see, was it worth it, the things that I spent money on? We all know that the number one cause of stress is debt. So you need to understand and analyze your current situation and then choose a strategy that you're going to follow in order to pay the debt. So there are two main strategies. The first one is paying your smallest debt first, and then the second one is paying your most expensive debt first. So you can engage with your financial planner or someone that assists you in terms of managing your finances, or you can go through this journey on your own and then decide and put together a plan that will be easy to follow. And then as you go through that, there are moments of celebration, like with this one of paying the smallest one first. It's easy because once you've paid off that 2,000 Rand store card, now you can move to that 5,000 Rand credit card. And there's different ways in which you can do that and find money in your budget. So the reason why I ask how you're finding the budget, and Mama Khadi shared that it shows you that there's things that you were not doing properly. And another thing that I want to add is that the budget shows you where the money is. I always say that money always leaves footprints. And when you say it's brutal, Naki, it's necessary. It's brutal, but in a good way, because it moves us from one level of financial wellness to another. And then in order to analyze your debt, this is similar to what you have on your spreadsheet. So with this, it's a matter of saying, what is the date? What is the original debt amount? What is outstanding? What is the interest rate? And then the debt term, the remaining term, any service fee, and any insurance fee that you're paying. So as you analyze this debt, there is different aspects with different debts. Some have an insurance premium, some have a monthly administration fee. So as you go through your statement, or as you go through your banking app, you'll be able to see that, okay, I'm paying 1,000 Rand back for this particular debt, but how much of this money is going towards the repayment of the debt itself? And you'll be surprised with some people or some kind of debt. On 1,000 Rand repayment, you can find that only 200 Rand is going towards the repayment of the debt itself, and then maybe 600 is going towards the interest. Another is going to the admin cost, other one is going to the interest. So the moment you get to be aware of how those things are being allocated, you'll be able to make a conscious decision. For me, it was a aha moment a few years back when I had a credit card that I had used to pay for my postgrad in financial planning. And when I looked at that statement, I was paying a monthly amount, the minimum allocated amount. And then later on, I checked the statement, I checked the number of months that I've been paying, and it was not making sense. So I had to go to the statement, find out what is really happening with the money that I was paying. And I could see that I have money at the end of the month, but I'm not allocating it to that because I'm not aware what my monthly or the minimum that I'm supposed to pay is doing to my debt. And what I did was to increase the monthly amount that I was paying, and I also put any extra money into the credit card itself. And with the credit card, the tricky thing is it's more of a revolving credit. So once you repay it, you still have access to it, and then you can get the money back. So what I did, and another tip that I always share with my clients, is once you've put money into your credit card, let's say you owe 5,000, and then you repay the amount, you decide, okay, let me put 1,000, even though they're gonna need a payment of like 300 Rand or 500 Rand. So what you need to do once you've paid that amount, once they've taken their interest and their fees, you need to call the bank, or you need to go online and then reduce that credit limit, so that it's no longer 5,000 Rand, it's 4,500. And then now you can track your progress. Every time you put the money in, make sure that you don't have access to it if your goal or your plan is to eliminate that debt. Because we've got people that would say, I'd rather just manage the debt. So they want to keep it there. And then when you ask, why do you have this? They're like, it's for emergencies. But you are providing for emergency using other people's money. And when you use other people's money, there is interest that you need to pay. So it's critical that you understand that when you use other people's money, you are going to pay for it. So I'm just going to take the next 5 minutes and go through a few slides. I'm going to share the slides, and after that, we can have the rest of the time to have a discussion. And then I did say that come ready to share what is working for you. And yeah, let's assist one another. This monthly money meetings are mostly discussion forums where you can also share tips and also assist one another in this financial journey. So monthly money meeting for May, it's on using credit wisely. And I'll go back to some of the things that I've also indicated when we're still starting. So what is credit? It's a financial arrangement. There's a lender and a borrower, where the borrower receives money or goods and services in exchange for a promise to repay the money with interest, usually over time. And this is a tool that can be used for managing finances, but if not used wisely, it can be very dangerous. So according to the World Bank, this is some stats. There's always stats when you do presentations. So the estimated populations of South Africa in 2020 was approximately 60.2 million people. And when it comes to the states of the National Credit Regulator, NCR, they had a total of 27.98 million credit active consumers as at September 2021. So 27.9 million credit active consumers compared to 60 million people. So that's like half of the population are in debt. And the population above includes also the youth and the children that are not yet credit active, though some people are credit active from a very young age. So with that, you can see that over half of the population is in credit, and 9.9 million of those had impaired records. When we talk about impaired records, it means they're behind in their payments or they've defaulted on their loans. And then 85 of that was unsecured credit. So with credit, there's secured credit, there's unsecured credit. When it's secured, that's when there is an asset, or what other people would say it's collateral, that you've put against the loan to say, if I'm not able to pay, then they can take this particular asset. But with unsecured, it's things like your credit card, because there is no asset that is linked to the credit card itself. So if you cannot pay, then you just become a defaulted person. It affects your credit score. And I would also welcome, as we get into discussion, people to share about their experiences with credit, if you are comfortable, and also in the past month, I think I've engaged with about 3 or 4 people who mentioned that they are in credit review, or they've just gotten, or they are wanting to get out. And these are the things that we need to discuss, because it's our reality. When I say 9.9 people have impaired records, they're behind on payments, they defaulted on their loans, I am sure that some of us here are also falling into that state where we are behind on our payments, we've defaulted on the loans that we have. But not to despair. The reason why we're having these sessions is to make money conversations normal. We normalize talking about money so that we can make better decisions when it comes to our finances. Now, let's talk about using credit wisely. I've got a few tips here that I'm going to share, just 5 of them. As we discuss, you can expand on this, or you can also share more tips. The first one is on understanding your credit score. So this is a number that represents your credit worthiness. And the higher the score, the more you'll be approved, or you're more likely to be approved for credit and receive a better rate. So you are allowed a free credit score once a year from one of the major credit bureau. So it's important that you go and register, get to check it out. One of the most famous that most people are using just to keep track on how they're doing on that credit score, then it's a ClearScore. So you can check it out, just go ClearScore, and then you will be able to register on a monthly basis. They send you a report in terms of how you're doing with your score. And just to caution, there's also some tips, or they tell you that if you take this credit, you're going to better your score. But what I say is, it needs to be in line with your financial plan. If I'm not planning on buying an asset or a house, a car where I'll need a favorable interest rate, there's no need for me to be taking that extra credit card for things that are not even on your plans. So everything must make sense. And then using credit, use credit sparingly. So when I was talking to my colleague the other day, we're talking about credit and debt. And we're saying credit is having access to the money that you can use. And then debt is when you have used that money and now you have to pay it back. So here we're talking about what is available. So just because you've got access to it doesn't mean that you should use it for everything. Most people, when you ask, how did you end up here? I'm going back to that money story or the debt story in terms of how you got there. People will say, no, I just qualified for it, so I took it. I used to work in the bank where it was part of my scorecard to make sure that I give you a call. So I would be the one on the other side and say, Mr. Chikovi, you qualify for an upgrade, or let's increase your credit cards, or let's give you a revolving loan. And with that, just because it's available, it doesn't mean that you have to take it. So you need to make sure that you use credit according to what is important, such as buying assets, and not use it for luxuries and vacations. Yeah, we can't be catching flights using credits. I know that hurts, but one of us here is in the travel space, and the ones shared a tip in terms of how you can start saving up for your holiday. If we're going away in December, we're still in May now. So make sure that if you need 1,000 Rand for that getaway, then you start saving, even if it's 100 Rand or 200 Rand every single month. If you're going to need 10 grand to travel, then make sure that every month you're saving that 2,000 Rand or 1.5 to make sure that you have the money to avoid traveling on credit. Pay your bills on time. This is very important because late payment can have a negative impact on your credit score, making it harder for you to access credit, and also you can be given a higher interest rate. So Yes, we don't catch flies with credits, hey? And the fourth one is keep your credit utilization low. So when you have access to credits, you need to compare the amount that you have available compared to the amount that you've used. And when you keep it low, it helps in terms of improving your credit score and showing the lenders that you are responsible with credit. And the last one, which I will stress very much, is for you to read the fine prints. So before signing any credit agreement, it's important that you read the terms and conditions. I know you're going to say, but they write in very small font with the bank. And then interest rate, fees, penalties for late payments or early repayments, because some products you also pay a penalty for paying early because now you're not doing according to the contract that you signed. So you need to understand those things, and then you need to be aware. If you are using taking credit from the bank, they always highlight it, and then they tell you total cost of credit. They tell you how much you're taking. They tell you how much the interest is going to be. They always tell you what the initial or the initiation fee is. And then they combine those things, and then they tell you the total cost of credit is going to be this much. And when you look at that number and then you do that calculation that we spoke about earlier on around understanding the total cost of credit, you'll be able to see how much more percentage on top of what I am earning or what I'm taking, and then you make a better comparison. Yes, the interest rate is there as a rate that they're going to give you, but does that include the admin cost? Does that include the insurance cost? Those kind of things you need to take into consideration, and that total cost of credit, they've done the calculation for you so that you make an informed financial decision. And lastly, from my side, before I open and then we have a discussion, is that credits can be a valuable financial tool when used wisely. We talk about understanding your credit score, using credit sparingly, paying bills on time, keeping that utilization low, and reading the fine print. So we need to avoid debt, and thank you so much for listening. So I'm going to open this engagement to say, if you've got any questions, comments, tips that you'd like to share, feel free to raise your hand, and then, or you can type on the chat, and then we'll give you the platform. You can also share about your experience with debt. And another thing that I noted, I'll just continue talking until I see a hand, and then I'll hand over to you. When Mama Khadi was sharing about her experience with the budgeting template that we shared last month, she kept on using the word I, my. You know, in some of the sessions, they tell you, no, you don't use the word I, you must use we. But when we talk financial management, personal financial planning, personal financial management, this is the place where you are encouraged to use the words I, my, because this is personal. It's part of personal financial management. I'm sure by now you know that with financial planning, there's 6 different areas. We talk about personal financial management, which is mostly the work that we're doing here about understanding your finances and making critical decisions that will assist you have a better tomorrow. And then there is retirement planning, where we plan for retirement. It can be before retirement and during retirement, and also planning at retirement. We had a discussion on Facebook this past week where I was talking about how people go on pension and then they want to use their money to start businesses. And it's a very sad reality, because people lose their money without understanding the essence of starting and running the business, or they invest in in schemes that promise to give them more. So it's important that we plan for retirement. So that's retirement planning. There is investment planning, where we look at different goals that are available, and then we plan for them. And there is risk planning, which is insurance, where you're looking at different insurance that are available and how you can better position that. Yeah, talking about insurance, I saw other content that we'll be sharing on our Facebook platform, just different types of insurance, how you can use that to assist you. We were doing codes on life cover for one of our clients, and just explaining the details before we can even do the codes. It was a matter of saying, what do you need to know about this journey as we're still starting? And we had that discussion, and they were very clear. And then now they were like, okay, let's do this. And it's a different story when you first understand what you're getting yourself into. And once you also have those products, it's critical that you do a review, find out what does it entail, how does it best benefit me. So those are some of the things. So we've got risk, retirement, investment, and then there's wills and trust. So that one is on protecting your legacy and also transferring your wealth to the next generation. So with that one, even this morning, I woke up to a text when someone was like, how much is a will? How much do you charge for a will? And I'm like, it's free. And then we'll explain the details, but this is one of the products where we don't want to not have people have wills. So people that are in my network, or if you know me and you don't have a will, I don't know you, because that is the starting point. Tsakani, I would ask you to unmute, and then you can contribute. I see you've written on the chat as well to say your plan is to pay off Access mortgage bond in order to have more allowance. Should I need access to cash? Is this considered a good plan? There's a question on the chat. Anyone that would like to take it up? We are having a discussion. Paying off Access mortgage bond in order to have more allowance. Should I need access to cash? Is this a good plan? Malebo, you're most welcome to unmute and contribute. And also introduce yourself as you contribute. Thank you.
Hi everyone. My name is Malebo, and I'm a colleague of Malalo. I'm also a financial advisor / wealth coach, and I help people with money. And it's a very interesting question. I have enjoyed the tips that Malala has shared so far. I can also use it for myself, because you know what they say, a doctor doesn't heal themselves. Sometimes you need to listen to these sessions, even though you know to get what other people are viewing. So Malala, I'm very I enjoyed the tips that you have shared, but I also want to talk about a trend that I have been seeing with people, especially when it comes to cars. Because once you finish paying off your car, maybe it takes about 5 years. I know most people, they take the, maybe Mulalo, you can further discuss, because it's also a topic, it's a mouthful topic, the residual value of a car. You take it on residual, and after 5 years, you haven't finished paying for it. And then some people opt to take a new car, some people opt to refinance. I'm not sure how people, because I've never really taken a car on a residual, so I don't know how people do it. But in most cases, people, they change cars after 3 years and everything, and they don't, and yeah, they are constantly in debt and everything. So I would just like to say that, you know, a car, like I have been driving my car for more than 10 years. A car has a lifelong span, and you don't have to buy a new car after every 3 years. You don't have to take it on a residual and now having to pay a car a lifetime, because now you don't. I mean, cars are expensive. You'll find that you are paying something like 6,000 rand a month, and for you to constantly for all your life to pay 6,000, that 6,000 you can pay it maybe for 5 years, and after that, that 6,000 can go towards something else, and you keep on driving the same car. And the argument that I get from most people is that maintenance of the car. Surely, if you're paying 6,000 rand a month, if you times that by 12, it's about how much? My mathematics is it's about 64,000. I'm sure the maintenance of the car is never going to be something like 64,000 or something like that in a year. So I think people should be wise to say, once they start paying off their car, they save 3,000 towards car maintenance, so that it's inevitable that the car will break or anything. So, you know, it's something that you can fix, you can service the car and everything, so that you are not constantly in debt paying the car. That can help you. You know, a car lifespan can be longer than 5 years. It can be 15 years. It can be 10 years. So I would like everybody to sort of like realize that and you know, and get out of that cycle of paying a car and everything. Thank you, Mulalo.
Thank you very much, Malebo, for that contribution. Malebo is with WealthFin. She's based in Pretoria. So if you need to have assistance or financial planning with someone that side face to face, be sure to reach out, and then she will be happy to assist. I'm based in Thohoyandou in Limpopo, and then I'm happy to assist. So with functionalities like Zoom and telephonic, then I can also assist irrespective of where you are. We've got clients all over the country, so you're spoiled for choice when it comes to financial planners. So I've noted that there are 3 things that have been raised when it comes to debt. The first one, the question that Tsakane was referring to, was payment of the Access mortgage bond, and then to have access to cash, and then she's asking if that is considered a good plan. And then the second one that you've just raised, Malebo, it's on the car. And I love when you mention that, so that you are not constantly in debt. Some people don't realize that they're in debt because it's a norm. You buy your car through the bank, and then later on you need to change it, and then they tell you, okay, I need to refinance it, or let's give you another one and add that existing debt to this new debt. So those kind of things. But what's critical is for one to look at comparing rent figures. What are we saving? And also understanding the details of this residual. I'm hoping someone will be able to come in and then share about, I think sometimes you say we're asking for a friend. You can also say you're sharing for a friend without saying that you're the one that has gone through that particular aspect, so that we can learn. And then you can say, my friend took this on residual, and then they just found out after year 5 that they owe X amount on their vehicle. I had a similar case when I was still with the bank. I was in Richards Bay with Nedbank. That's where I did my financial planning. So I was sitting there, and the next thing, this couple, Ubaba, Noma, they walk in and they were having the shock of their life. I just overheard the conversation with a banker, because you see those cubicles in the bank, in the branch, but they were just finding out for the first time, when they thought they were done paying the car, that there is a residual, or there's a balloon payment that they need to service or to pay for. It was a painful moment, but with this generation that we're in, and the work that we're doing on ensuring that people are literate, people are making informed decisions, it shouldn't be an issue. When you're buying a vehicle, you should know what your options are, and what each options, the effect on your repayment, on the interest, on the term, everything should be up to you to decide. So the third one that I see on the chat, it's from Carol, where she's saying that, let's say you have 2 credit cards. Sounds like a better positioned person, eh? 2 credit cards. Other people have 3, and others they have 4. So let's say you have 2 credit cards, and then they're charging you interest on both. And then can you pay off the other and have only 1 credit card? We mustn't use all our credits, because it affects the credit score, and then you'll be able to pay the monthly installments. Your advice on that. So this is another one that I'm going to also throw on the floor, to say, if anyone would like to share inputs when it comes to that, then you're most welcome. You can just raise your hand or note on the chat, and then we'll give you time to contribute and also share tips when it comes to that. So there's a question on the house, there's a question on the car and using the residual, and then there's also one on the credit card. So anyone that would like to contribute in any of this? Mama Khadi, you're most welcome to unmute and contribute.
Thank you very much, Milalo. On the house issue, I had a conversation with one institution when coming to this payment, extra payment on the house issue. And the advice I got was the mistake that as persons we make, or as individual we make, is we do these extra payments, but we do not inform our financial institution. It's very much important that as soon as you start making those extra payments, you need to have a conversation with your banker or your institutions that has financed you on that bond, because so that they can be able to allocate that money where it needs to be allocated. Because if you keep on paying and paying, your money will just pile up there without having interest or without doing anything on your interest. It will just be money sitting there, a sitting duck without anything. So I would advise anyone that making extra payment on their bond to have a conversation with their bank to say, this is the money that I'm putting away for, maybe for, yes, I'm putting it in a bond, paying off my bond earlier, but in case of emergency, I don't know what's the term for that, but in case of emergency, maybe I can use it for renovations or something. Thank you very much.
Thank you for sharing that. It's very critical. I made a note here around a conversation with your financial institution, because your creditor, the person that gave you money, they trusted you. So they're your friend. So you should have that conversation with them. And if you want to structure a better plan to repay, it's important that you engage them. Zakani, you're most welcome to unmute and contribute.
Thank you so much, Molalo. Just to add on what Mama Khadi said, or maybe to rephrase my question, to stay away from debt, what I'm trying to do is that since I already have a bond house or a mortgage bond, The plan is to try and pay it off or pay as much as I can. So the conversation has already started saying that, okay, you saying that I should pay an installment, for example, of 5,000. I'm going to be paying, let's say 10,000. I'm going to be doubling it so that I can reduce it from 20 years to 10 years. So after 10 years, when I have much allowance or an increased advance in the bond, for example, I can go and buy a vehicle. So the financial institution that has subsidized me is already aware of this plan that's going on. But now my question is, in this area of financial planning, is that considered a good plan to have allowance to your mortgage bond, or should maybe one consider taking credit from other financial institutions? So I just wanted to hear your input or how other people are doing it in that aspect.
Thank you for that addition and also provided clarity. So it's a personal journey, and depending on what your plan is, then whatever you decide, as long as you are deciding based on available information that makes you make a better choice, then that would be a plus. So what's critical is to understand the effect of the decisions that we're making. I always say that every decision is a financial decision, but what is that financial impact? What is that impact on my finances, considering what I have done? Malebo, you're most welcome to unmute. We've got 2 minutes left from the session, so if you'd like to contribute, you can share on the chat and then also just raise your hand. Malebo?
Hi guys, I heard on my, you couldn't hear me clearly on my last comment. I hope you can hear me clearly. I'm using Bluetooth earphones, so I'm not sure whether it contributes to that. But can you hear me clearly, Mulalo?
Yes, I can hear you, and I could also hear you on the last engagement.
Oh, okay, all right. Okay, I just want to maybe share some enlightenment to two questions that we have. The one where they said they have 2 credit cards and they want to pay off the other one using the other one. This is just a thought. It's not an advice. I'm just saying that, if the other interest rate has lower interest, it's probably better to go for that option. This is just my suggestion. So it could be good if it's called consolidation. You're basically consolidating 2 loans. So if the other one has lesser credit, it's gonna save you a couple of rents if you can pay off the other. But yeah, like the Mulalo says, that the personal journey, you need to be aware of the consequences of your decisions that you make. So but what I'm saying, the point that I just want to say, that it's possible and it can save you a couple of rents. Although now it means that you might mix up the other one, but if you're paying on time, it's not gonna affect your credit card that much. But what is more important, to save rent or to have a good credit score? You have to weigh up those options. And another one, another question that I need to tackle. The last lady who spoke, what was her name?
Sagani.
Sagani, yes. She was asking about, now I lost what was she asking about again?
The access bond and going through that journey of paying more.
Oh, yes. Yes, she was asking if you have paid the access bond, can you use that money to pay off the car? what I also want to make her aware of is that a bond is 20 years. The question that she needs to ask herself is that she wants to pay off a car in 20 years. Because for me, you pay more interest. It might look like the bond has less interest rate. So you can take advantage of that if you know that if you buy a car using the Access bond, you're gonna make sure that you pay off that car in 5 years. Then that will benefit you. But if you don't have the capacity to pay the car within the 5 years, of which a normal car loan will offer you, then you are losing, because then you'll pay that car within 20 years, which means you'll pay more interest. So, you must weigh up those options when you are faced with that decision, because on the surface, it looks like it's a good idea because it's lower pay